Hello and welcome to another Global Macro Update. Woo! Took a couple weeks off for a little vacation, but I'm back at it. So just going to start things off with a quick summary of the stories I'll be getting into today. Starting with Cathie Wood over here is calling for a Fed pivot.
Say what?
The U.S. issued some aggressive chip rules.
Huh?
Semiconductors, not Doritos. Russia rained down missiles after the Crimea bridge attack. The Bank of England says it's ending its bond buying stimulus. Biden is reevaluating the U.S. relationship with the Saudis after the recent OPEC decision to cut production. Some European nations are fighting nuclear and natural gases. They're labeling as green.
No!
And Binance had $100 million stolen in a hack, and it would have been more, which would have, I think, like 500 million, which would have been the most stolen in a crypto hack to date.
Not crazy.
But before I get into those stories, let me go over last week, or really the last couple weeks, as I was on vacation. Definitely picked the wrong time to go out, but gonna hit some of the highlights, starting with Japan intervened in the FX market to backstop the yen.
For real? You fuck with that?
The Bank of England switched to QE to save its over-leveraged pension funds.
Oh, hell no!
And someone bombed Nord Stream 2. U.S. unemployment numbers went down.
What?
That definitely surprised markets. Then we had U.S. manufacturing PMI came in well below expectations.
Come on, man.
Elon said he's buying Twitter at the original $54.20 per share price.
My man!
And as I mentioned, OPEC cut production by 2 million barrels per day.
And we say bye-bye!
Although they were already below output, so technically it won't account to exactly 2 million, but neither here nor there. Still a big deal. All right, well, that does it for last week. Let's jump into the stories for this week, starting with the producer price inflation, which hit 8.5%. Now, before I get into that, let me just explain, I guess, what it is. So the producer price inflation is a measurement for final demand, month-over-month changes in the price for commodities sold for personal consumption, capital investment, government, and export. It is composed of 6 main price indexes. Final demand goods, which is about a third of it, which includes food and energy. Final demand trade services, which is about a fifth. And final demand transportation and warehouse services, which is 4%. And then it also includes final demand services, less trade, transportation, and warehousing. So I guess in a nutshell, it's kind of not really maybe that helpful for some people. In a nutshell, it's measuring inflation for producers. So not just like CPI, measuring kind of on the consumer end of it, it's for producers. So it is a big deal because it's like the inputs, and I guess you could say maybe it's like a leading indicator, because if it affects producers, they raise prices, and then that affects CPI, and you know.
Totally.
You get it. All right, so anyway, with that out of the way, the producer price index for final demand in the U.S. went up 0.4% month over month in September, the first increase in 3 months. You can see this chart for those who are watching. We had the last 2 prints in July and August were negative, and so we're back in positive territory. Not good. So it went up 0.4% despite the expectation of a rise of 0.2%. So the cost of services rose 0.4%, with prices for traveler accommodation services jumping 6.4%. The indexes for food and alcohol retailing 2.6%. Portfolio management, not even sure why that's in there, 2.1%. Machinery and vehicle wholesaling 1.5%. Oil and gas well drilling services and hospital inpatient care 0.4%. But I think I at least got some more important ones in here. So the ones I wanted to highlight, I guess, specifically. So fresh and dry vegetables up 15.7%. Now, that's a lot. We all eat food, so it's a big deal. What else we have? So price for diesel fuels up 9.1%. I'm sure everyone's acutely aware of the rising gas prices. Then residential natural gas up 2.6%. Chicken eggs 16.7%.
Not crazy.
Now, I don't know about you, but I eat a lot of eggs, so that's upsetting. Home heating oil 10.7%. Pork 5.5%. And then the index for gasoline fell 2%, although despite diesel going up. It's kind of interesting. Year over year, producer prices rose 8.5%. which is the smallest rate since July last year, but still, as I mentioned, slightly above forecast. But I mean, this is a big deal because the idea is that inflation is supposed to be going down. I mean, that is the goal. That's literally the Fed's singular goal right now. So when you have things like this going the opposite direction, that is not a good sign, because that means the Fed is probably going to tighten even more, despite some of the other signals that the economy is slowing or whatever. Now we have inflation numbers like CPI, PCE numbers, which I would say are probably more important, especially just in terms of like the headlines that'll come out. That is tomorrow, and so very, very important to watch, because depending on what the print is, that could really, really move markets. But yeah, if this is any indication, it could be a bad print. All right, moving on to the next story. Okay, so Fed Evans says fighting inflation is the top priority, even if that means job losses. Now, full disclosure, Evans is not a voting member of the chair or the FOMC, so take what he says with a grain of salt.
Little bitch.
But that being said, his message is still kind of consistent with the overall committee, so still important to consider. So with that out of the way, Chicago Federal Reserve President Charles Evans said the central bank is holding fast in its commitment to bring down inflation, even if it means people losing their jobs.
And we say bye-bye.
Speaking 3 weeks before the Fed is expected to approve its fourth consecutive 75 basis point interest rate increase, the central bank official told CNBC he hopes to minimize economic damage. I mean, obviously, but at the same time, they're saying, basically, we want more people to be unemployed. So, can't really have it both ways.
You're a fucking idiot.
Here's a quote. Ultimately, inflation is the most important thing to get under control. That's job one. Price stability sets the stage for stronger growth in the future. Not going to argue against that. Definitely makes sense. On the employment front, the Bureau of Labor Statistics, BLS, reported Friday that non-farm payroll increased 263,000. So 263,000 new jobs, while the unemployment rate fell to 3.5%.
Not crazy.
Which is tied for the lowest level since late 1969. So the Fed is trying to think, I think they've set a, tentative target, maybe not explicit, but they want to shoot for like 4.5% to 5% unemployment. And that's obviously a long way to go, especially if unemployment is going the opposite direction. I mean, we fell from 3.6% to 3.5%, and they want to push that up to 4.5%. So that means they have a long way to go, and that could lead to a lot more aggressive policy decisions. You already have a lot of the other countries around the world switching to easing policies, which I'll get into some of them. Bank of England being the most obvious example, or I guess Japan too. Really, everyone's starting to buckle, but they are, they have these goals that are just not being actualized or even headed in the right direction. So this is very, a not good sign if you are hoping for a dovish Fed. Another quote here: if unemployment goes up, that's unfortunate. Of course. If it goes up a lot, that's really very difficult. But price stability makes the future better. So they're flat out saying it. And Powell, whose opinion obviously matters a lot more, he's been saying the same stuff. Unemployment isn't a good thing. It's a negative consequence of reinstating price stability, which is the ultimate goal. So they don't really care that much. They care. Little c care, but they will do what it takes to restore price stability, even if that means a massive unemployment spurt. And they, like I mentioned earlier, they are basically hoping that unemployment gets to 4.5% or 5%, because this is kind of based on, it's called the Phillips curve. They believe that unemployment is related to inflation. Like when inflation, to get inflation down, you need unemployment to go up, because there's just less pressure from the workforce and wages and all that. So now that model is a little bit broken, but that is what the Fed kind of is relying on here. So they are basically trying to tackle inflation by forcing people out of work.
Totally.
All right. Well, on that happy note, next story. So this one's kind of funny. Cathie Wood, I'm sure everybody knows her at this point, but she's been saying this for a long time. And to her credit, I guess she's not completely off base, but she has this bias, obviously, because her funds are very speculative, and they high beta ETFs that rally as risk assets. So she wants the Fed pivot because, she has a financial incentive, obviously. So full stop. But at the same time, she is somewhat right, and there are a lot of deflationary forces, and the Fed is kind of overlooking some data that they probably should be paying attention to. They're focused on a lot of backward-looking data rather than forward-looking data, and monetary policy, it affects the economy with a lag. So when they raise interest rates, it doesn't really affect the economy till maybe 6 months or even like a year or something afterwards. So them raising rates like now is not really going to do much, and so that's more or less in a nutshell what she's getting at. But I'll just go ahead and read some of this. So the Federal Reserve likely is making a mistake in its hardline stance against inflation. This Cathie Wood said Monday in an open letter to the central bank. Instead of looking at unemployment and price indexes from previous months, Wood said the Fed should be taking lessons from the commodity prices that indicate the biggest economic risk going forward is deflation, not inflation.
Not crazy.
The Fed seems focused on two variables that, in her view, or I guess ARK's view, are lagging indicators: downstream inflation and employment, both of which have been sending conflicting signals and should be calling into question the Fed's unanimous call for higher interest rates. The Fed has approved 3 consecutive interest rate increases of 75 basis points, mostly by unanimous vote, and is expected to okay a 4th one when it meets again on November 1st and 2nd. Inflation is bad for the economy, no shit, because it raises the cost of living and depresses consumer spending. Deflation is a converse risk that reflects tumbling demand and is associated with steep economic downturns. Nearly 40 central banks around the world approved increases during September, and the markets have largely expected all the Fed's moves. However, criticism has emerged recently that the Fed could be going too far and is at risk of pulling the economy into an unnecessary recession. Another quote from Cathie: "Without question, food and energy prices are important, but we do not believe that the Fed should be fighting and exacerbating the global pain associated with a supply shock to agriculture and energy commodities caused by Russia's invasion of Ukraine." Now, what she's kind of alluding to here is the Fed is obviously focused on inflation, but they don't really have the tools to tackle the kind of inflation that's really hitting these indexes or hitting people. They can't affect energy markets by raising interest rates. They can't grow more wheat or crops or whatever it is by raising interest rates. They don't really have the tools to tackle this, and they are basically just trying to kill demand by forcing people into an economically terrible place and terrible standing. And so there is a lot of merit to what she's saying. Like I said, you have to take some of it with a grain of salt because of her financial interest, being that she is running a fund that would very much benefit from a Fed pivot. But at the same time, she still is, for the most part, right, I guess.
Totally.
But yeah, I thought that was interesting. She's not alone, too. I just, the media loves Cathie Wood, so this is a big story. But I've heard a lot of people talking about this. Jeff Snyder, he's been talking about this for a year. I think since October, before the actual crash started, he's been talking about these deflationary forces in the backdrop of the economy. So, it's not like she's standalone in this, and she is talking about there are real signs, forward-looking data that is indicating the economy is slowing rapidly. So yeah, like I said, definitely some merit to this, but take it with a grain of salt. Anyway, moving on. All right, so the U.S. aims to hobble China's chip industry with sweeping new export rules. So this is a recent decision Biden went through, or I guess the administration went through, regarding semiconductors. So the Biden administration published a sweeping set of export controls on Friday, including a measure to cut China off from certain semiconductor chips made anywhere in the world with U.S. equipment, vastly expanding its reach in its bid to slow Beijing's technological and military advances. So the rules, some of which take immediate effect, build on restrictions sent in letters this year to top tool makers, KLA Corp, Lam Research Corp, and Applied Materials, effectively requiring them to halt shipments of equipment to wholly Chinese-owned factories producing advanced logic chips. So from what I've read and heard, China is, roughly at a, a commensurate level in terms of AI, but they are a little bit behind in the chip manufacturing. And really the whole world is behind TMSC, Taiwan, and their, I think like 90% of the world's advanced microchips come from Taiwan. So pretty much every country is trying to play catch up with regard to semiconductors. And the US is really, they're 5 years too late on this realistically, but they are finally starting to take steps, recognizing the seriousness of the situation, and they are trying to, with this, more or less prevent China from building up their semiconductor capabilities. Here, let me continue. So the raft of measures could amount to the biggest shift in U.S. policy towards shipping technology to China since the 1990s. If effective, they could hobble China's chip manufacturing industry by forcing American and foreign companies that use U.S. technology to cut off support for some of China's leading factories and chip designers.
Come on, man!
So in a briefing with reporters on Thursday, previewing the rules, senior government officials said many of the measures were aimed at preventing foreign firms from selling advanced chips to China or supplying Chinese firms with tools to make their own advanced chips. They conceded, however, that they had not secured any promises that allied nations would implement similar measures and that discussions with those nations are ongoing. The new regulations will also severely restrict exports of U.S. equipment to Chinese memory chip makers and formalize letters sent to NVIDIA, AMD, Advanced Micro Devices, restricting shipments to China of chips used in supercomputing systems that nations around the world rely on to develop nuclear weapons and other military technologies. Now, speaking of these semiconductor companies, this is part of the reason the Nasdaq had a big dip in the recent week. Really, semiconductor chips falling, leading the way with that decline, and it was largely because of this sweeping act, because a lot of these companies, it's China. Everything on this like global level runs through China in some way with regard to supply chains or whatever it is, some type of manufacturing element. So rules implemented by the U.S. government like this, they have serious implications, and there's a big scare as to who's going to be able to effectively navigate this. Is this going to lead to increased prices or just some kind of disruption? So this is definitely a big deal. The semiconductor thing is probably going to be one of the biggest issues going forward in the next decade. There are other issues like food shortages and stuff that might take a front seat, but this is definitely going to be one of the biggest problems going forward. China's Commerce Ministry said in a statement on Monday that it firmly opposes the U.S. move as it hurts the normal trade and economic exchange between companies in the two countries and threatens the stability of global supply chains. The U.S. should stop the wrongdoings immediately and give fair treatment to companies from all over the world, including Chinese companies. And last little bit, on Saturday, China's Foreign Ministry spokesman Mao Ning called the move an abuse of trade measures designed to reinforce the United States' technological hegemony. Now, obviously, China's going to be against this. They're against pretty much anything that, understandably so, that is not favorable to them. But yeah, this is definitely something I want to keep looking at. I don't know exactly what or how this is going to be implemented, or I guess the consequences of it, how effective or whatever it is. But definitely a huge story to watch, just because, like I said, this is going to be one of the biggest stories going forward. Just everything around semiconductors, around Taiwan, why it's such a big issue, because the whole world, for the most part, is reliant on Taiwan for all the semiconductor chips in our computers and our phones and our military equipment. So it's a huge deal. All right, next story. All right, so this isn't exactly related to financial markets, but it is somewhat related, because it's just a sign that the war in Ukraine, Russia-Ukraine war, is nowhere near a close. And that means that the supply chain disruptions and the geopolitical tail risks that are baked into the market right now, the prices, is probably not going to abate anytime soon. Aww. But let me get into it. So, I'm sure at some point, this is one of the biggest stories. Everybody's probably heard this, that the Ukrainians, I believe the Ukrainians, I think there is some speculation that it could be someone else, plausible deniability, but realistically, the Ukrainians bombed a bridge in Crimea of key infrastructure for the Russians, and like a day, I can't remember if it was a day or a couple days after Russia retaliated, and they basically just started throwing missiles everywhere, bombing Kiev and other cities, and really, I think their goal was to hit key infrastructure. They didn't really take out anything significant, but obviously, some people died. It was pretty crazy. But again, just a sign that this war is nowhere near a close. So President Vladimir Putin unleashed a far-reaching series of missile strikes against cities across Ukraine on Monday, hitting the heart of Kiev and other areas far from the front line. In the broadest assault against civilians since the early days of Russia's invasion. Putin said the strikes on almost a dozen cities were retaliation for a blast that destroyed sections of a bridge linking Russia to the Crimea Peninsula, though they also seemed intended to appease hardliners in Russia who have been openly critical over the prosecution of the war. Now, this is an important point that I think a lot of people don't consider as much, unfortunately, and that is that the people around Putin, the high government officials or military officials, they are even more hawkish. A lot of them, maybe even most of them, are more hawkish than Putin. They want Russia and Putin to go further and really start making this a full-scale, committed war. And so a lot of people think, like, we just need to get Putin out of office. Like, that, honestly, that could be dangerous. That could be worse, because who's going to take his place? Maybe one of these hardliners that wants to just go straight to nuclear war, or go just take steps further than Putin has already. And so a lot of people are viewing this as Putin appeasing some of those hardliners in his, circle, cabinet, whatever you want to call it. But yeah, so who knows if this is going to continue? Like I said, there's a lot of people calling for, in his close circle, calling for continuation or more attacks like this. So it seems to me that this is just getting more and more serious. It's not showing signs of a close, and that is obviously a big deal for financial markets, for oil markets, commodity markets, all that stuff. Aww. All right, next story. Okay, so this is one of the biggest market headlines in the last week, and that is British pension funds press the Bank of England to extend its bond buying stimulus amid a cash scramble. So UK pension schemes are racing to raise hundreds of billions of pounds to shore up derivatives positions before the Bank of England calls time on support aimed at keeping them afloat. Let me add a little bit of context here, I guess. So the Bank of England, their bonds, their gilts, the yields were rising dramatically, and their pension funds are leveraged, basically. So they are leveraged long bonds. And when yields go up, bonds go down in price, meaning they're, leveraged long something that is losing value. And that means they will get a margin call and have to post more collateral. And they don't really have the collateral, and they are the biggest, pension funds are one of the biggest holders, buyers of bonds. So there isn't really someone to, replace that. Like if they're selling, there's no real buyer that can replace that other than the government. They are the buyer of the last resort. They are the only one with the capacity, the balance sheet that can really help them. And so that is what inspired the Bank of England to start basically switching over from, like I said, the day before saying they were going to do quantitative tightening. They're like, all right, quantitative easing, we're buying the bonds, we're backstopping these pension funds so they don't blow up. But this story is saying that they're not going to continue doing that, and I think there's a lot of tension right now in the I guess UK politics, because the government is saying they're not going to backstop the pensions, but they almost certainly need to, or they probably will need to again. And if I really doubt they're going to let them fail, but right now it seeming like they might. I don't know. Like I said, there's no way they will. I can't imagine them letting the pension funds fail. But the Bank of England was basically saying they're going to stop buying the bonds, and they're telling the pension funds to just figure it out.
Little bitch.
So Governor Andrew Bailey said on Tuesday that the Bank of England would stop buying bonds as planned on October 14th, so coming up, which would leave pension schemes scrambling after a surge in yields to meet a collective cash call estimated to be at least $355 billion without a buyer of last resort. With pension schemes calling for a deadline extension, the Financial Times on Wednesday reported the Bank of England had earlier signaled to lenders it might continue the emergency program beyond Friday if market conditions demanded it, stoking confusion. So they said they were going to stop it, but that the Bank of England said they would stop their bond buying program. But if the market conditions demanded it, they would consider keeping it. So, like I said, without them being the lender of last resort and, kind of engaging this quasi yield curve control or just helping yields stay a little bit low, pinning them a little bit lower so that these pension funds don't get absolutely obliterated. It's going to be hard to stop that without someone like the Bank of England intervening. So something tells me they will have to intervene again unless some miracle happens and these pension funds figure it out. But pension funds right now are trying to raise cash by selling off UK government bonds. And this is actually the irony. So, as I mentioned, they have to post collateral, right? Or post some type of cash collateral, whatever it is. And their collateral is bonds. Like, that's the biggest asset they hold, is these bonds. So when they're getting these margin calls to post collateral, they are having to sell the bonds to give them, to raise cash. But in selling those bonds, it is raising rates even further, which leads to them having to sell even more because they're getting even more of a margin call. So it's kind of this feedback loop that, for lack of a better term, fucks them. So the pension funds are trying to raise cash by selling off UK government bonds, or Gilts, their name for bonds. I'm not sure where that came from. I'll have to do a little history lesson. So bonds, index-linked, and corporate bonds, but the fundraising tasks is intensifying. Tuesday's Bank of England intervention targeted the relatively small index-linked bond market, which is dominated by pension funds, and suffered another significant sell-off this week. The Pensions and Lifetime Savings Association on Tuesday called for the Bank of England to consider continuing its bond buying until October 31st and possibly beyond. You've got 3 days left, the Bank of England said this. You've got 3 days left now. You've got to get this done. And then we have, I don't know who this is, but Natgas Patel, head of client solutions at Kempman Capital Management, calculates that pension schemes collectively need to post 160 billion pounds of cash as collateral for every potential 100 basis points move in yields. So for every percent that these gilts go up, the pension funds collectively are going to have to post about 160 billion pounds.
God damn!
And they started, I think, when this started getting real crazy, they were at like 3.5%, and they just jumped like close to 5%. I think that's like roughly where they are right now. So that is, that's a huge move. I think someone pointed out I saw it on Twitter or something, that volatility in the gilt market, UK bond market, is more than Bitcoin right now. So we have sovereign debt of one of the biggest countries in the world, the UK, trading more volatilely. Is that a word? Volatilely?
You're a fucking
It's more
idiot.
volatile than something like crypto, which is, so basically government bonds are trading like shitcoins right now, which is absolutely wild.
Come on, man.
So the Natgas Patel estimates the total cash funds now need to post could be 320 billion pounds or higher. We are definitely not there, he said, referring to whether funds were close to raising that required cash by selling assets. He described last week as one of the biggest ever for sell orders. You are seeing more sales this week. He estimates pension funds could sell assets totaling around 300 billion pounds as they adjust hedging positions, including 100 billion pounds from gilts, as well as assets like global credit, global equities, and asset-backed securities. It's not clear how much they may have sold already. So this is a big point because if they're gonna have to raise cash, you sell whatever you have. You don't sell what you want to sell. You sell whatever you have because you need cash. And so if they're holding equities or holding whatever other asset, they're selling it. That's gonna put downward pressure on all these other assets. So this is how you get like contagion effects. When companies go under, get margin called, they have to sell assets that are really completely unrelated to whatever thing is blowing up. So if the government bonds or UK government gilt market is blowing up and they need to raise capital, who knows, maybe they own a bunch of Nasdaq or something. I'm not saying they do, obviously you have to look into their holdings or whatever, but whatever they're holding, they're probably going to have to sell to raise cash, and that is going to have this contagion effect that could lead to margin calls for other companies that are just long equities or whatever it is.
Not crazy.
All right, last bit. The bottom line is a lot of schemes need to rebalance their portfolios. That is not going to stop and will take time. So we're hardly out of the woods yet. All right, next story. Okay, so we got UK labor market mass exodus drives jobless rate down to 3.5%. Now, this is funny because you think, I mean, not funny, I don't know, maybe it's the wrong word, but the UK jobless rate, the unemployment rate, went down, kind of similar to the United States, but they're saying it's for really bad reasons because people are leaving the workforce. It's because technically, I know this is the way in the US. I don't know if I'm assuming it's the same way in the UK. When someone leaves the workforce and they stop looking for a job, they're no longer counted in the unemployment rate. So if you were just like completely out of it, you're like, deuces, I'm leaving the market. You're the employment market, whatever it is, the economy, I'm just signing out. You are no longer included in the unemployment rate. And so they're saying that is potentially why this is their unemployment is going down. So it's not a good sign, as in like more people are getting jobs. It's more people are just checking out. So Britain reported a record jump in the number of people leaving the labor market in the 3 months leading to August, adding to the Bank of England's inflation headaches, which, I mean, it's already at 9%. I think the next inflation print for the UK is estimated to be 9.9%.
God damn!
Crazy. Let's see if we can't get that 10 handle. So the leap pushed the unemployment rate down to its lowest since 1974 at 3.5%, below a median forecast of 3.6%, but offering little comfort for the Bank of England. It is worried that Britain's shrinking labor market will fuel inflation pressures that are also likely to be fanned by Prime Minister Liz Truss's unfunded tax cuts. God, UK is such a shit show right now. So while there were tentative signs that the labor market is cooling from the red-hot conditions seen in recent months, the shortfall in labor supply is keeping it exceptionally tight.
That's what she said.
That will maintain intense pressure on the Bank of England to raise rates aggressively over the coming months. Investors are betting heavily on a full percentage point increase in its next policy announcement on November 3rd as it moves to offset the inflationary implications of the tax cuts. Yeah, so with the Bank of England, transitioning to QE, doing these tax cuts and all this stimulus. I mean, they had like an energy cap for businesses, and that basically means they're subsidizing energy. I mean, you get all this stimulus while they have inflation that's, just kissing 10%, double-digit inflation. So they got to do something, and their only tool right now, I guess aside from not doing all this stimulus, which they kind of need to, otherwise the whole economy is just going to like collapse. Their only tool is interest rates, so they're thinking about doing a full percentage point. That is more than any major central bank has done. I mean, the Fed has stuck to its 75 basis points, even though it's been doing them consistently. It hasn't opted for a full percentage point yet, so that is big news. Now, I don't know if I would rely on that interest rate differential, meaning going long GBP USD, because I think that the UK is just in a weird situation right now where higher rates don't necessarily make it a better option, but still, we'll have to see if they continue doing this because they got to get something figured out. And I don't know. I heard someone raise an analogy. It's like they are trying to reduce inflation, like they have a pool filled with water, right? That's the inflation pool, and they cut a hole to reduce inflation while they're taking buckets and pouring water in. So they're basically doing nothing. They're just letting this, they have like tightening and easing, canceling each other out.
You're a fucking idiot.
All right, next story. Got a lot of positive stories today, guys. Okay, so India's September retail inflation accelerates to 5-month high of 7.41%. So India's retail inflation accelerated in September to a 5-month high of 7.41% year over year, driven largely by surging food prices, raising fears of further rate hikes when the central bank meets for its next policy review in December. Annual retail inflation in September was higher than the 7.3% forecast, not a crazy miss, but still a miss, and above the 7% print the previous month. So although broadly in line with expectations, the CPI data continues to remain elevated. The surge in prices of cereals, it's kind of funny, vegetables, and pulses is continuing into October as well. The unseasonal rains are further expected to keep the food prices volatile. We expect the Reserve Bank of India to hike the repo rate by 35 to 50 basis points in December, with the next move being more data dependent. And price momentum still remains broad-based, but this will require continued monetary policy tightening. and the magnitude will depend on balancing growth and exchange rate considerations. I like that last little bit that they're considering. So if the Indian rupee has some difficulties, that could definitely influence what their policy ends up being. So this is a quote: "We maintain that even if inflation print comes off, inflation risk is growing in the form of wide external trade deficits. Policymakers will have to take action to restrain import-intensive domestic demand through taxes and trade policy. Both monetary and fiscal policy have to turn restrictive." All right. Well, yeah, so, I mean, this is not a huge story. A lot of people probably don't care that much about India, but at the same time, I kind of wanted to highlight this because food inflation, I just got done reading Peter Zion's book, The End of the World is Just the Beginning, and one of the main takeaways is that we're going to have massive food inflation over the next decade, whatever it may be, just because of deglobalization and a lot of the, I guess, places where we grow things like wheat, rice, all the, whatever. A lot of the marginal producers of that, they're very sensitive to just minor changes in climate or whatever it may be. And so we're probably going to see food prices continue to rise pretty aggressively just as all these kind of headwinds come to fruition. I mean, they're already kind of showing themselves. Another big one is fertilizer shortages. There are shortages for like all the different kinds of, because we have like natural gas, which is a big input to some types of fertilizer, phosphate. I can't remember the other one, but there's a lot. All these inputs are basically, there's shortages of all those, natural gas, phosphate inputs into fertilizers, and so the fertilizer shortage is just, it's never been more serious, and so I wouldn't be surprised if this is going to be an ongoing problem, because they're pointing to food basically being the primary driver right now of this inflation, beating expectations. And India's a little weird. I think they have like a range. How the Fed has a 2% target for PCE. In India, they have like a range of like, we want to shoot for 2 to 6% inflation. So technically, it's not that far off their wide window. But still, who knows? Maybe it exacerbates. Like I said, over the years, and food inflation could become pretty aggressive. Aww. All right. Next story. Okay, so as I mentioned earlier, the Saudi Arabia, which is one of the main, them and Russia are like the biggest members of OPEC Plus, I guess technically, and they cut production, or said they were going to cut production by 2 million barrels. And this is kind of a slap in the face to Biden.
Come on, man.
Because he obviously wants gas prices down, and he wants OPEC to increase production to help him out. And this, especially after visiting them, and, people keep saying like, oh, you fist bumped the MBS, Mohammed bin Salam, I think that's his name. Basically the de facto leader, king, if you will, of Saudi Arabia. And so, went through all this, all the, the politics of going and visiting and asking these things, and then turns around and more or less does something that is consistent with with Russia's goals. And so very bad news for I guess they're good news for them because they have an economic incentive. They're going to be making shit ton of money, billions and billions from oil prices this high. But obviously for Biden, gas prices have already gone up like, I live in California, so I have the worst gas prices. It gets like over $6.50. I think I saw one picture of gas at over $8.
God damn!
Come on, man. All right, so President Joe Biden pledged on Tuesday there will be consequences for U.S. relations with Saudi Arabia after OPEC Plus announced last week that it would cut its oil production target over U.S. objections. His announcement came a day after powerful Democratic Senator Bob Menendez, chairman of the Senate Foreign Relations Committee, said the United States must immediately freeze all cooperation with Saudi Arabia, including arms sales. So that's a big deal because that's, I think, one of the main reasons that Saudi Arabia enjoys their relationship with us because we sell them so many arms. There's other reasons, like we provide protection in a general sense to, I guess, the global economy, including them. But they like our arms. They need our arms. We have some of the best military equipment, and so that is something that I guess U.S. politicians or U.S. officials are saying that we need to stop to kind of get them in line, like basically take away the thing that they enjoy the most, and we'll maybe play ball with them if they play ball with us, that kind of thing. So in an interview, I think it was yesterday, with Jake Tapper on CNN, Biden said he wouldn't discuss what options he was considering for the consequences for OPEC's decision to cut production, but there was going to be some sort of consequence. Now, in the interview, it was made out to be kind of a nothing burger, like he didn't really say anything. So we'll have to wait for more developments to see if he actually does something. But yeah, we'll see. Because I think Jake Tapper even asked him about not selling arms to Saudi Arabia, and he said, I'm not going to say what I'm going to do. And I don't know, it was, like I said, nothing burger. So Saudi Foreign Minister, Prince Faisal bin Farhan, I don't know what the hell that is, said the OPEC Plus decision was purely economic and was taken unanimously by its member states. I mean, of course it's economic. They make so much money. I mean, there might be some political aspect to it, but I mean, it's hard to deny. They have a huge economic incentive. I think I saw some chart a while back ago where, like, the last quarter, Saudi Aramco, so their main oil company, made like over $40 billion in the quarter, which was more than like Apple, Microsoft, and Google combined. It was some ridiculous stat like that. So they are raking it in. It's ironic in this whole like crazy situation with the Ukraine-Russian war, deglobalization, and commodity prices surging, or oil prices more specifically surging. Saudi Arabia has been the biggest winner, I would say, in the last several months, and because of how much money they've been raking in.
Not crazy.
So the United States accused Saudi Arabia of kowtowing to Russia, which objects to a Western cap on the price of Russian oil in response to Russia's invasion of Ukraine. U.S. officials had been quietly trying to persuade its biggest Arab partner to abandon the idea of a production cut, but Saudi Arabia's de facto ruler, Crown Prince Mohammed bin Salman, was not swayed. Yeah, so this is him. I love his little sandals. Just had to show those. It's the leader of Saudi Arabia right there, guys. All right. So on that somewhat happy note, let's transition to the next story. All right, so this is ridiculous. So Austria, and I think other countries too, but Austria specifically seeks allies for legal challenge to EU green investment rules. Because recently, just amid this energy crisis, the EU kind of revisited its rules around green energy, like what's considered green, and for, I guess, the sake of survival, because there's like regulations that prevent them from doing certain things, investing in certain things to build out infrastructure. So they changed to have nuclear and natural gas included in that because they desperately need both. And now you have these suicidal countries like Austria that are saying they don't want that to be included. Now, I can understand the argument to natural gas, although I think the situation kind of demands they accept it for temporarily, especially being that it is the least pollutive fossil fuel. But nuclear energy is like the least pollutive energy source ever, and well, not ever, but you know what I mean. Like realistically, it is. I think it's even less pollutive than a lot of the renewable sources, especially if you consider like the whole supply chain involved in it, like with solar, and especially the turnover. Like solar panels only last like a decade, and then all those materials get thrown in landfills and stuff. And same with wind turbines. So if you consider like the whole process, supply chain, start to finish, and like the long term, I believe nuclear is the least pollutive. It's also the most power dense or energy dense power source out of all of them. I mean, it is more dense than even oil. And so I think them labeling nuclear as green made sense, and it's also their best shot of actually becoming energy independent and surviving. So I really don't understand why they're arguing against nuclear. I can somewhat understand the natural gas, but again, I think they should make a slight exception for the medium term, given the situation they're in, but I digress. So, Vienna on Friday filed a legal challenge against the EU's inclusion of the energy sources on a list of climate-friendly investments, which exposed deep rifts between countries over which energy sources to use to meet climate change goals. Luxembourg confirmed on Monday it would join Austria's action. Austrian Environment Minister Leonor Gewessler, some of these names, man, said others may follow without naming the countries. They don't want to know. So Austria, Germany, Luxembourg, Portugal, and Denmark jointly called for nuclear to be excluded from the rules last November.
You're a fucking idiot.
I swear to God, dude, these people are self-destructive. When the EU was still drafting them, Ireland and Spain had also warned Brussels against labeling investments in gas as green. The EU's so-called taxonomy is a rule book defining which investments can be labeled climate-friendly, designed to guide investors towards green projects that will help achieve the bloc's emission-cutting targets. Austria's legal action submitting to the EU's General Court makes 16 arguments for why Brussels should annul the rules, including that nuclear energy cannot meet a requirement to do no significant harm to the environment because of concerns about radioactive waste. Way overblown. They're completely missing the boat. So the European Commission proposed the law in February after more than a year of intense lobbying. Some Central and Eastern EU countries had argued gas investments should be inventivized. Is that a word? I don't know. Inventivized to help them quit more carbon-intensive coal, while states, including France, see low-carbon nuclear energy as key to cutting greenhouse gas emissions. Well, at least France got their head out of their ass because they need to go nuclear. They really do. It is the best energy source in pretty much all fronts. And an interesting statistic, per terawatt hour of generated electricity, nuclear is the safest energy source out of all of them. And so that means like death per terawatt hour. So every like 1 terawatt hour, I can't ever remember if it was like 1 or for every 10 or 100 terawatt hours generated of nuclear energy, about like 100 people. Oh fuck, I'm butchering the statistic, but basically the least amount of people per unit of energy generated, which is the important thing, because we need X amount of energy to run the world, run the economy. So if you have that much energy coming from this source, how many people are going to die? And coal is one of the worst because of all the pollution and just dangerous, and mines and all that stuff. And renewables are better. They're not as bad as something like coal, but nothing is better than nuclear. And so if you're worried about human life, nuclear is the best energy source. And a lot of people's complaints about nuclear energy are rooted in like old technology, or like, they quote or reference Fukushima, which is kind of like a freak accident. And, there's lessons to be learned from that, obviously. But even with all these like freak accidents, nuclear still has the least amount of deaths associated with it per terawatt of energy generated.
Not crazy.
And I don't understand. I mean, they have every reason. The EU has every reason to go nuclear right now, like to save their life. They are in such a weird situation. And for them to still be holding on to this, like virtue signaling, we need to be green, even though nuclear is green, I just really don't understand it. They're absolute idiots.
You're a fucking idiot.
All right, transitioning. Got me heated now. All right, so Russia could deliver gas via Nord Stream 1, but not Nord Stream 2, according to Germany. So Germany will not take Russian gas via Nord Stream 2 pipeline, a government spokesperson said on Wednesday, after Russian President Vladimir Putin offered to resume supplies. The spokesperson added, however, that if Russia wanted to resume gas deliveries, it could do so via Nord Stream 1 pipeline. Putin said earlier on Wednesday that the Russian gas could still be supplied to Europe through one remaining intact part of the Nord Stream 2 pipeline, but the ball was now in the European Union's court on whether it wanted to have that happen. Now, I find this interesting because it's almost as if Putin is arguing for like getting natural gas to Europe now. I think he likes the idea of controlling himself, like this on-off switch, and also Russia needs money. I mean, they are, in terms of like sovereign balance sheets, they are healthier than a lot of these other countries, pretty much every other country, especially in Europe. So they can kind of withstand some, lack of income, but that is one of their biggest sources of income. So even though they cut it off for this kind of like geopolitical reasons, they are losing a lot of money by doing that, because if they're not giving the gas, they're not getting the money, and they need that money, especially with how expensive wars are. So this is a big deal. In terms of an income stream for Russia. Now Putin, that is, saying that he wants to kind of organize some sort of way to get that natural gas back to them, I find very interesting. Is as if he's basically saying like, hey, like I want to go back to playing this cat mouse game where like I turn it on, shut it off, because I want a little bit of income and I also like the leverage. So yeah, I found it very, very interesting to say the least. And then last bit from this piece, asked if Germany ruled out receiving gas through Nord Stream 2, the spokesperson replied, yes. So that's a big deal. Germany's basically saying they're not going to take gas from Nord Stream 2, and maybe that's because they've, amid all this craziness, they've secured energy sources from other places. I know they've built out a number of LNG, liquefied natural gas terminals to get like shipments from, I believe one of the biggest contributors is Qatar, maybe, and the U.S. too. So a lot of countries that are just shipping LNG. It's more expensive, but I don't know. Maybe they're trying to get more serious about not giving money to Russia. So maybe that's why they're taking this harder stance. But I find this interesting because it's almost like Putin is begging for them to take the gas. I mean, not really, but you know, in so many words.
Totally.
All right, next story. So, Turkish energy minister said Putin proposal for gas hub in Turkey should be discussed. So, with the the attacks on these pipelines and issues with the pipelines, they're trying to figure out a different way to get gas to Europe. And Turkey is kind of like throughout the war, they've been kind of this intermediary. Partly because they are literally like right there in the mix of it, in terms of like location. They're right by between Ukraine and Russia, so it makes sense. But just also in general, they've kind of had like good relationships with both sides. I mean, they're a NATO country, but they're also somewhat buddy with Russia. But anyway, I digress. So let's get into this. So Turkish energy minister, I'm done pronouncing names, so I'm just going to skip that, said on Wednesday that it was too early to comment on Russian President Vladimir Putin's proposal for a European gas hub in Turkey, but added that the issue should be discussed. Speaking at the Russian Energy Week conference in Moscow, both Putin and Gazprom, which is basically the state-owned energy company, head all these names, Alexei Miller, suggested creating a gas hub in Turkey. Putin said that Russia could redirect supplies intended for the damaged Nord Stream pipelines to the Black Sea to create the hub in Turkey, or even use the one intact part of Nord Stream 2 to supply the European Union. So this is kind of similar to the last story of Putin is trying to find ways to get natural gas to Europe. And again, I find this very interesting because it seems as if he is worried about losing that income stream, or maybe the leverage, or both. Like he wants to be able to give them gas so he can take it away and regulate it at certain times to kind of affect them or keep them dependent. Because as long as he keeps them using a little bit of it, maybe the European countries are less willing to go to other countries to source like 100% of their energy. So yeah, it's kind of like Putin. Like I said, he's trying to get desperate, trying to find ways to get the gas to Europe, despite playing these games and cutting it off half the time, or cutting Nord Stream 1 down to 0%. So yeah, very fascinating.
Yeah.
All right, well, that out of the way, let's transition to our final section, crypto. So Google Cloud is letting users pay with Bitcoin, Ethereum, Dogecoin via Coinbase. I think a number of other currencies are included, but those are the main ones, obviously. So internet giant Google today said that it will use Coinbase to accept crypto payments for cloud services early next year, according to a report by CNBC.
Say what?
Google announced the deal at this year's Cloud Next, a conference where Google pitches its state-of-the-art cloud computing business, which accounts for nearly 1/10 of its revenue to companies. The terms of the deal have not been disclosed, but according to Jim McDowell, Vice President of Business Development at Coinbase, the deal will follow other Coinbase commerce arrangements, earning Coinbase a cut for every transaction that goes through the system. CNBC also reported that there wasn't a guarantee that Google would stick with Coinbase for payments processing, and there's competition from a newly crypto-integrated PayPal business service. For now, though, the San Francisco-based crypto exchange, Coinbase, appears to be the top choice.
My man.
Yeah, so this is a big deal. I mean, whenever you have these huge companies, I mean, this is the giant. This is, it's not quite to the level of Apple or Microsoft, I guess, but basically there. You got them, legitimizing crypto by incorporating payments into some of their services. So I know this seems like kind of a more micro thing, but when you have one of the biggest tech giants in the world starting to legitimize crypto with, including payments in some of their services, that is a big deal.
Totally.
Okay, next story. And this is our Binance, our last story. So, Binance Smart Chain hack could have been worse if validators hadn't sprung into action. So, over the weekend, the Binance Smart Chain, a blockchain closely connected with Binance, obviously, was the latest victim in a hack that ultimately drained the ecosystem of $100 million in crypto. I believe it was the BNB token. So the exploit, however, could have been much worse. While the hackers were able to get away with roughly 100 million, the potential amount could have been as much as 570 million.
God damn!
And I believe that would have been the largest crypto hack to date, which is wild, but ended up only being 100. So what we're seeing here is that as we see more of these attacks on bridges, the communities that rally around these blockchains are getting much better at shutting them down quickly, updating their systems, and being able to prevent a worst case scenario from happening. It only took 100 hacks stealing millions and millions of dollars for them to get their shit together, but it's good. I guess they're finally solving it. Or not solving it. $100 million still got stolen, but yeah, they're getting better. At least that's what they're saying. They're getting better at finding these, identifying the hackers, and whatever. So luckily, the validators of BNB, or Binance Smart Chain, sprung into action really quickly. We're able to lock down the chain and actually prevent the lion's share of that new minted BNB from being able to actually leave the ecosystem. Because those 26 validators are able to work with one another so quickly, they're able to prevent that worst case scenario from happening. Now, I think that quote right there is somewhat of a nod to the centralized chains, because Binance Smart Chain is a more centralized chain. And they're saying because the validators were able to work together, as like a company almost, so quickly, they were able to prevent this. So I imagine that is somewhat of a nod at this is why we have a more centralized chain like Binance, and why it's better than something like Ethereum or whatever have you, or what have you. So to ensure the BNB token is growing at a sustainable rate, and because the hackers didn't steal someone's money, the BNB community is planning to include $2 million worth of BNB tokens in its upcoming burn this year as a way to bring it back down to parity. The BNB chain community is working with law enforcement to track down the hackers, who he suggested could be either a state-based actor or a threat group that is tied to a state actor. Now that part is wild. So they're basically saying that it could be, or maybe likely is, a state-based actor. Now I am waiting for the day where we get real state actors attacking crypto, especially if it happened with Ethereum or Bitcoin. Like some state actor gets a huge stake in Ethereum, and they start affecting the chain, or approving fraudulent transactions, or just muddying up the system. Who knows? Or they purchase a bunch of mining rigs and get the majority of the hash rate and start, again, throwing a monkey wrench in the Bitcoin system. And who knows? The only people who can really get away with that are actors with like unlimited state government actors with unlimited balance sheets. But who knows? That could be. So who knows? Maybe this is a sign that is to come. Like they're practicing, right? All right, well, I'm rambling, so we're going to go ahead and draw this to a close. Because that is all the stories I have for you today. But actually, before I get out of here, let me go ahead and talk about what we got coming up next week. Oops. All right, so U.S. and China inflation numbers are coming out tomorrow. I mentioned the U.S. ones. That's definitely more important than China. No offense, China.
Little bitch.
Forecast for US CPI is 8.2% versus the previous month's 8.3%. So they're forecasting it to decline. If we see a surprise to the upside, probably not that good. And then for PCE, 6.4% versus the previous 6.3%. So that's interesting. The forecast for PCE is supposed to be higher. And that's probably because, well, I don't know, energy has kind of rebounded. So who knows? But PCE is what the Fed is focused on, because PCE is, or sorry, not PCE, core CPI. But core is, they use core PCE. This is core CPI, which is slightly different, but pretty much the same. Anyway, the core part is what you want to focus on, because the Fed 2% target is based off of core inflation. So if core inflation is going higher, that is worse. Like they would rather have probably CPI go higher and core go lower, because that is them getting closer to their 2% target. So bad news. And then for China's forecast, CPI, or their inflation, is 2.7% from 2.5% last month. So their inflation is expected to increase. And then we have on Friday, U.S. retail sales and consumer sentiment numbers come out. Next Monday, we get China's Q3 GDP numbers. Last quarter was a positive 0.4%, and the forecast is a positive 0.8%. And next Tuesday, we get UK inflation numbers. And like I mentioned, I think earlier, the previous month and the forecast are both at 9.9%. So again, I'm waiting for that 10% handle. I think they already hit it a couple months ago or something. But yeah, that is all I have for you today. But on that note, stay happy, humble, and if you're the Bank of England, solve it. I'll catch you all next week.